Today we're going to take a look at this Claudia question, which is a cash flow, statement of cash flows question from the ACCN3 paper from June 2019. The reason we're looking at this today is that we haven't yet seen a cash flow question in section B of the paper 1 exam, which is where we would expect it to turn up. So I thought it'd be a useful exercise to go through this. So the question is here. I've also got a little Excel spreadsheet, so I'm going to do some of the workings and hopefully the video will switch between the two. So the directors have given us some information, some balances at the 28th of February 2018. And they've partially completed the statement of cash flow for the year ended 28th of February 2019. So essentially we're going to be filling in the boxes that are shaded, except they've missed a shaded box out there. We need to find the net cash used in or from investing activity. So the beauty of this question is we've actually got the layout, so we can revise that as we go along. So the first part is reconciling the profit from operations, dealing with timing differences, non-cash adjustments like depreciation, and so on, to eventually arrive at the net cash from operating activities. So if you remember, usually we'd stack up the information on the left-hand side and just put the total out into the right-hand column so that we've got three clear totals: money derived from operating activities, money coming from investing activities, that's the buying and selling of non-current assets, and money either used in or from financing activities, so that's to do with loans and shares, paying dividends, that kind of thing. So without further ado, I'm just going to work through this question, showing you where the numbers are coming from, hopefully, and how to deal with it. So we've got some information here about the cost of non-current assets and the depreciation to date on them. And if you remember, this is all at the end of last year, so these are opening balances for the year, which begins on the 1st of March 2018. Corporation tax 21,310, so that's the liability, that's what was still owing at the end of last year, so that's been brought forward as a credit balance, a liability at the start of this year. We've got 6% bank loans, £150,000 worth there. Ordinary share capital, £187,500 worth. But what we need to be aware of is the fact that, as you can see down here, the nominal value is 20 pence each. So they're not £1 ordinary shares. So we actually have 5 times the number as we do the monetary value, which will be important later on when we start dealing with bonus and rights issues and paying dividends. We've got some retained earnings and some share premium already in there. So what we're going to do is just work through the pieces of additional information. I'm going to switch over onto an Excel spreadsheet, and my plan is to do all the workings first and then go back onto the cash flow statement and fill in the numbers. So additional information number 2. Now I've already kind of populated the spreadsheet, so you don't have to sit there watching me painfully typing away throughout. So the bonus issue is where we do free shares. We issue free shares to our shareholders. So it's not actually going to have any impact on the cash flow statement at this stage. But what it will do is mean that there are more shares in circulation. So when we come onto the rights issue, which is extra information number 3 there, that rights issue will be based on all the shares in issue at that date. So the ones we had at the start of the year and the ones that we're issuing on the 31st of March. And then further down, I think we've probably paid a dividend, if I remember rightly. Yeah, number 6, we've paid a dividend of 3 pence per share, and that's on all shares in issue. So that's the original shares up here. So 5 times that 187,500. And then the bonus shares, which are 1 for 4, and then the rights issue, which is on the basis of 1 for 3. So let's start with the bonus issue then. So what we need to do first of all is think about the existing shares. The way we're going to calculate that is to take the monetary amount, 187,500, and either divide it by the 0.2. Don't multiply it by 0.2 because you'll get a very small number. Or I think the easiest way is to think, well, how many do I get to the pound? If they're 20 pence shares, I get 5 to the pound. So let's just do that sum, 187,500 times 5. So that gives us 937,500 shares. Now it's really important that we label up these figures. So if it's a monetary amount, we put a pound sign in front of it. And if it's a number of shares, we write shares next to it. Because as we go along, it's going to get more and more complicated. So we need to be able to identify what's what. So in terms of the number of shares then, the bonus issue, we don't have to worry about any money because we haven't received any for this, but the bonus issue of shares was made on the 31st of March on the basis of 1 new share for every 4 shares held at that date. So the way we work this out is we change that into a fraction. So 1/4 times 937,500 shares gives us our new shares. So it's basically that figure divided by 4. So we've got 237,500, and we could just total up the number of shares there. So that's how many shares we've got in total after the bonus issue. So 1,171,875. Then we can deal with the rights issue. So we're going to deal with this in terms of the amount of money received, but also the number of shares. So let's find out what the existing shares were. Well, we've got that. So the rights issue is on the basis of 1 share for every 3. So 1/3, convert that into a fraction, times 1,171,875. So I'm just going to go plus that divided by 3. So those are the new shares that are being issued under the rights issue. And again, I'm going to work out how many shares we've got in total. So we've got 1,562,500. Now we need to know how much money has been received. It tells us that the shares were sold at a premium of 12p per share. So we've received 12p plus the nominal value of 20p. So we've actually received 32 pence times 390,625 shares. Okay, so that's the calculation. So let's just get rid of that out of the way for the moment. So the money we've received, 0.32 times the 390, we've actually received £125,000 worth. Okay, so let me just follow my own advice and stick a pound sign in front of there. Now the number of shares we've got, let's just retotal that because we're going to need to use that figure in a sec to pay the dividends. So we've actually got 1,562,500 shares. So that figure, I'm going to put that in bold, is going to need to go onto our cash flow. So that £125,000 is going to go as a receipt, and it's going to be under the financing activities there. So let me just pop that in while I remember. So 125,000, and like with a lot of things to do with accounting, we don't necessarily have to do things in exactly the right order. So don't worry about trying to find depreciation for the year. We can just pop the figures in as we know about them. Right, so then we've got number 4. We've got a non-current asset to deal with that's been sold on the 30th of June. It tells us that it had originally been purchased on the 30th of November 2016 for 28,320. So it was bought on the 30th of November. It was bought for 28,320. What we don't know at this particular moment in time is how much depreciation has been provided on that asset. We also don't know how much it was sold for. Now, what we need to do is, because if you remember the statement of cash flows have been partially completed, we may find, and here it is, look, under cash flow from investing activities, it tells us we've got proceeds from the disposal of non-current assets. So the actual sale proceeds were 20,625. So we can put that in on our spreadsheet here. So that's the sale proceeds, if you like. What we need to do, though, is find the net book value. So the depreciation that we're going to work out, it was bought on the 30th of November 2016, and the depreciation tells us in note number 9 that all non-current assets are depreciated using the straight line method at a rate of 25% per annum. Depreciation is charged on a time apportioned basis. So that means that from the month we buy it right through to the month we sell it. So I worked this out earlier, and I think if we start depreciating it in December 2016 and we go through to June 2018, then that's going to be 19 months worth of depreciation. So the way we're going to work that out is we're going to start with the cost, and we're going to say 28,320 times 25%. Okay, and then we're going to multiply that by 19/12 to gross it up. So the depreciation is going to be 11,210. Okay, so that's the depreciation. Therefore, the net book value of the asset is going to be the difference between these two. So it's going to be the 28,320 minus that 11,210, 17,110. If we've sold it for 20,625, we've actually made a profit on disposal. Now, if you remember, the profit on disposal is adjusted along with depreciation in the top part when we're looking at the operating profit. So that is going to be part of our cash flow. So if we just go back over to the cash flow there, you can see depreciation for the year. We don't know what that figure is, but profit or loss on non-current asset disposal needs to go in that box there. Now, the rule is with depreciation, we always add it back. It's an expense that has reduced the profit from operations, but because it doesn't have any impact on the cash, we need to bump the profit back up. So when we put it into the income statement, it would have reduced profit. We will now be adding depreciation back because it's reduced profit, but it hasn't reduced cash. When it comes to a loss on disposal, that behaves in exactly the same way as depreciation. It's reduced the profit, but it hasn't had any impact on cash. If you remember, the cash part of this is that we added the proceeds in down here under the investing activities. So we're just dealing with the profit or loss. Now we know we made a profit of 3,515. So actually we're going to need to deduct that. So this can often be a little bit confusing, but we're going to take 3,515 away. The reason for that being that when we did this profit from operations, we would have included that profit on disposal, 3,515. That would have increased our profit from operations, but actually it hasn't had an impact on cash. So we need to remove it. We need to take it away. Okay. Right. So that's the disposal dealt with. Now, depreciation. We're going to have to work that out because remember we need to add that back. Now, if we look at the information here, we've got some assets that have been there all year. So of the 331,260, we got rid of one that cost 28,320. So the assets that have been there all year are the 331,260 minus that 28,320 that was sold during the year. So we've got assets of 302,940, and we're going to apply 25% depreciation on those for the whole year. That's 75,735. Then we've got the asset that's been disposed of during the year. Now that was got rid of in June, so it was only there for March, April, May and June, and I am using my fingers to count the months. Don't be scared of doing that. So it's 4 months worth of depreciation on the asset that's been sold. So the original cost of that was 28,320 times 0.25 times 4 over 12. Oops, I'll move that over to the other column there, just in the line. And then the assets purchased during the year were, what did we buy? Oh, let's have a look. In fact, it doesn't tell us anything about assets. It does tell us that one was purchased on the 1st of July, 2018. So it's been there from July, August, September, October, November, December, January, February. So 8 months. And let's find out how much it cost. We're going to need to look back at the cash flow for that. And we can see here, purchase of non-current assets, 93,780. So 93,780. So we're going to do 25% depreciation, and we're going to time apportion that by 8/12, so 15,630. So if we add up all of those together, let's just pop those in there, we should find the total depreciation is 93,725. So we've just scored 3 relatively straightforward marks, and we're going to pop that in there, 93,725 in our cash flow. Okay, so apologies for move that over a little bit, make that a bit easier to read. Right, so we've now got the first part of the statement of cash flow completed. So we can work out the cash from operations, which is a simple subtotal. If we add and subtract all of those figures, we will get a total of, I believe, 164,955. Okay, so as I said, that is just a subtotal of adding those two and minusing those. And just to recap, the reason we're removing the inventory, we've got an increase in inventory, so we've bought more inventory. That will have depleted our cash, but obviously inventory is deducted, closing inventory is deducted in cost of sales, so it won't have had a bearing on that profit figure because it's been removed. Trade receivables, remember we record the sales and therefore the profit when it happens, but if we've increased the trade receivables, that means those people haven't paid us, so we haven't received that cash, so that's why we're taking it away. And then the decrease in trade payables, that means that we've paid some of them off. So we've actually used our cash there, 9,750. So that's why we need to add that back on. Right, so we've still got interest paid and income tax paid to work out. So we're going to have the dividend paid as well. So we could work out the dividend paid, seeing as it's point number 6. So the total number of shares, now let's go back up here. We had 1,562,500 shares. So that's the original shares plus the bonus issue plus the rights issue. And each one of those is going to get a dividend of 3p. Don't multiply that by 3 because that would be £3. That's going to bankrupt them. Make sure you multiply it by 0.03. So not by 0.3, not by 3, 0.03. So we're actually going to be paying them £46,875. Okay, so that is the dividend. Let's pop that in on our statement of cash flow. We should find there's a spot for that. There we go, underneath the financing activities. And it's going to be a negative figure because it is an outflow of cash. Just trying to remember the amount. So 46,875, I believe, is the there. So that's going to go in, as I said, as an outflow. That's the dividend sorted. Let's now think about the interest paid. So we've got a loan that's there all year, and then we've got a bank loan of 125,000 that was repaid on the 31st of October. So we're starting with an opening balance up here, 6% bank loans, 150,000, but we've repaid 125,000 on the 31st of October. So again, don't be afraid to use your fingers to calculate this. So the 125,000 was only there for the first 8 months, March 2018, April, May, June, July, August, September, and October. Whereas this amount, the 25,000, has been there all year. So 25,000 times 0.06 is £1,500. The 125,000, the rate is the same. We're going to time apportion that for 8/12. So the total amount of interest paid is £6,500, and that can go straight into our cash flow. And that is going to be underneath the cash from operations. So again, it's an outflow. So it's a negative figure, 6,500 goes in there. Okay, we are getting there. I don't think there's much more to find now, apart from the tax. So the tax on profits for the year, if you remember, tax appears in several places in the account. So it will appear on the income statement. The figure on the income statement is the estimate of what the company thinks the tax bill will be for the current year. Okay, now that's not going to be paid. Generally, if it's a smallish company, it won't be paid until 9 months and 1 day after the end of the financial year. And if it's a larger company, like a PLC, generally, they will pay tax in instalments. So the figure that goes in the cash flow is never going to be the same as the figure that's in the income statement. If you're very lucky, the figure that goes in the cash flow is the exact figure that was in last year's income statement, but generally it's not going to be that either, because at the end of the day it's only an estimate. So the figure, the actual amount paid may well have changed. So the starting point for working out how much tax has been physically paid in the year is to start with what was owing. So at the beginning of the year we owed 21,310. It tells us in the note down here that they estimate the tax on profit to be 28,600. So we'll pop that in there. And then it tells us that at the end of the year, they estimated that they would owe still 24,175. So if we take that away, so start with the tax owing, add on the figure from the income statement, take off what's still owing at the end of the year, and that will give you the tax that's being paid. So let's just do some of that lot. So the tax paid is 25,735. Oops, put a pound sign. 25,375. What do I write out? 25,735. Sorry, I've gone a bit dyslexic. 25,735, and we can put that in on our little income tax paid there. So again, it's an outflow. It's money going out. 25,735. So the net cash from operating activities we can now calculate. That's going to be the cash from operations, 164,955 minus the 6,500 interest minus the income tax. So that's going to be a positive net cash from operating activities. Oops, let's edit that. It has generated a cash flow, positive cash flow of 132,720. The investing activities, we can now work out the net cash that's either been used in or from. Now, in this case, it's used in because we've got a minus an outflow of 93,780 and an inflow of 2625. So overall, that's going to leave us with an outflow of 73155. The financing activities have generated proceeds from the share issue of 125. We've used that to repay the borrowing, but then we've paid out dividends of 46,875. So the overall impact of those transactions is an outflow of 46,875. Okay, then we get to the clever bit down the bottom. We're going to add up these three. So we're going to take the cash from operating activities, the cash used in investing activities, and the cash used in financing activities, net them all off against each other. So add and subtract as necessary to find the overall increase or decrease in cash. Now, overall, during the year, Claudia PLC has managed to increase their cash by 12,690. And we can prove that because we've got a figure given to us cash at the beginning of the year, which is 5250. It was an overdraft, that's why it's in brackets. And then cash at the end of the year. These two will be figures that have come straight from the statement of financial position. So the 12,690 minus 5250 is in fact 7440, which is the correct figure there. Job done, 14 marks. Thank you very much for watching.